I'm Mike Alonso. As was introduced, I'm head of tokenization for the BIS. Now, what's important is my background. I'm not a central banker. I don't come from finance. I actually come from crypto, building different products for several years since 2016. I joined the BIS a few years ago, and what's interesting about the BIS is, well, they're very unique. They serve central banks, but they really have three products. One is banking services for central banks, because central banks need banking. Two, they provide a forum for central banks to talk and discuss about policy. And three, they do R&D for central banks. And so that's where I sit. I sit in the R&D side. And not being a central banker, I don't know anything about central banking. But let's recap what a central bank does. And I'm going to be very, very simple and hopefully a little fun. But central banks do two things. They ensure financial and monetary stability. And the first one we know, because it's really how we look at things and how we understand things. It's how much money is in the supply system. And they do it by buying and selling securities or interest rates. The other one is financial stability. Now, they'll say financial stability they really can't define. But we know what financial instability looks like. You know, the great financial crisis with instability. And the central banks step in to not do that, right? But what's also important is what they provide. And so here you have the central bank, and it's got commercial banks, and all the commercial banks have an account with the central bank. And when commercial banks pay each other, they pay each other in central bank money. We, retail corporates, operate with commercial bank money. And so if Acme wants to pay Alice, Acme tells her bank, hey, I want to pay Alice 100. Alice is going to debit 100 from Acme in commercial bank money, pay Capital Trust in 100 in central bank money, and then issue 100 in commercial bank money to Alice. Now, making sure this system functions is actually really core to the central bank. And so let's go through some history. This is actually really fun and interesting. So I'm going to talk about the Federal Reserve a little bit. Boring, but actually really fun. They used to be distributed and kind of decentralized. And so in 1913, when they started, they said this country's big. We need a way to make it a little bit more distributed and have more reach across the US. And so they distributed across 12 reserve banks. And so if you were a bank in New York, you would be with the Federal Reserve in New York. If you were a bank in California, your bank would be San Francisco Federal Reserve. And they settled to each other by physical cash and gold. Now, this is really cool, but it was actually really interesting because something weird happened. The FX between the US dollar in different jurisdictions was different. Now, that's weird. And so the reason what this was because, well, they took the impact of the cost of transportation and the interest lost if you transport money between districts. And going from New York to California is a very difficult, long journey. And this is very costly for end users. And so the Federal Reserve said, nope, let's make it faster and cheaper. And so in 1918, they did this thing called FedWire, and it's really the telegraph. And they said, well, can't we just call you and tell you, make a payment over there? And that's what they did. And FedWire has been operating for several years, but it was still distributed. And it wasn't physical cash and gold, it was book entries. This person has this bank has this. And then, in the 1990s, they did something unique. They centralized it. Now, this was also for the users. You see, over 70 years, you had these 12 different systems doing things differently, different message formats, different ways to operate, and it was costly, expensive. If somebody made a mistake, it'd be costly for the end user. And so by centralizing it, it's under the New York Federal Reserve now, it was cheaper, faster for users. In 2023, they did FedNow, which is instant payments between banks. So this is faster, cheaper, better. So, what does the future look like? Well, we think it looks like the unified ledger. And it's tokenized. And some folks will be in this room asking me, well, if you had instant payments, What's better about the next stage? And those that are in tokens and distributed ledgers know, well, there's a lot. So, back in, this is funny, so back in 2017, the first concept of central bank digital currency came out. It was actually called central bank cryptocurrency. And the central banks did not like that very much. So it's now central bank digital currency. This is a true story. And they created this thing out called the money flower. Now, all types of money live here. So if you look at Pokemon Go money at the top, you have Bitcoin at the bottom. But I want to point out a couple things. Commercial banks pay with each other in reserves today on FedNow, FedWire. Where central bank digital currency comes into play is really here. And what's different, it's got this peer-to-peer attribute, which we know. The other component is this retail central bank digital currency, and this is what's very controversial, this is what's very political. And it comes in two forms. Either I have an account with the Federal Reserve, or you have a direct account with the European Central Bank, right? Or it's just a digital token, like digital cash. I'm not going to talk about that. I'm going to talk about the wholesale side for bank-to-bank payments, because that's what's really important. So, you all know this, but let's just recap why tokenization matters for central banks. So, Bitcoin said it was a peer-to-peer electronic cash system. It did 4 things. It was a single ledger, a single unit of account, the Bitcoin. It had peer-to-peer transactions, no intermediaries, and it was no double spending. And one way to think about Bitcoin is it's really just one single smart contract. And it has one rule: don't double spend. It also means it does some things not that great. It's slow, and it has some limited functionality. Really, you can't program money, and we don't like that. We want to be able to do really cool things. And so Ethereum in 2013 comes along and says, hey, we want to do smart contracts. We're going to do the same things that Bitcoin did, except multiple units of account. We're also going to do some contingent actions, smart contracts, and composability. Now, amazing, we have programmable money. And so what commercial banks really like about this is that you can code financial contingencies, because finance is all about contingencies. If this happens, then that. So one way to look at it is that tokenization is already here, and central banks are just simply aligning with technology. The other way to look at it is, let's go back to that mandate about stability. So let's look at 3 examples: cross-border payment, securities, and policy implementation. First, let's look at cross-border payments and securities, because they're kind of similar. And so imagine you have 2 payment systems. One on the left is FedWire, the one for the US dollar, and the one on the right is what the European Central Bank uses, which is called Target 2. They're in different silos. They don't talk to each other. Next, you have the commercial banks that have accounts with the central banks. They're also in silos. And anytime you have silos and you want to integrate or have conversation or communicate is risk. If something goes wrong, we have to undo it, and how do we undo it? So this is a very good, valuable proposition for banks. Securities, this is actually really interesting. So I didn't know this, but securities are also settled on separate platforms, but they also have different communication mechanisms. So FedWire does payments. FedWire Securities just does securities. Why didn't they combine them? Nobody knows. Interestingly, it's also the same thing in Europe. Target 2 is for payments. Target 2 Securities is just for securities. And they're not integrated. So you have more problems with securities. So we don't like this siloed approach. And if we can combine them all with tokens on a programmable platform, we can eliminate a lot of risks. Lastly is this policy implementation. And we go back to this, but making sure that there's a good adjustable monetary supply. What's important here is this buying and selling securities. If you had an automated smart contract that lets banks sell a bunch of stuff to get liquidity really fast, that's important. The great financial crisis, one of the problems there was banks didn't have enough liquidity to sell their stuff. No one to buy any of the stuff that they were selling, of course. But they also didn't have facilities that would buy these things. And central banks serve a purpose where if a bank has just a bunch of stuff, they can sell it to the central bank, and the central bank will always buy it. So if we can automate that, that's actually really nice. Now, the banks get screwed on this deal all the time when they use these facilities. So where is the BIS focusing its time? So in 2023, we came out this tokenization continuum research, and it actually pretty flows kind of similarly to the crypto community. On the right side, we have things that are really good for tokenization. On the left, things that are not good for tokenization. People that have been in this space for a long time, like myself, know that supply chain and land is very difficult to do. The things on the right are really easy. So if you look at crypto now, domestic payments could be stable coins. You would have tokenized gold. You have Paxos Gold and some others right now. Cross-border, easily, stable coin to stable coin, euro to USD. And then DVP, you kind of have this concept already in DeFi. So how do we map this to what we're doing in the BIS? On the top, you have different tokens. So there's CBDCs. Deposits are commercial bank money, what I discussed earlier. Securities are government bonds. And real-world assets are things like commodities and gold. The left, you have use cases. So as you can tell, we've done a lot of experimentation. You can say we're probably the experts in central bank digital currency. But now we're full. And so now our focus is how do we actually do things better by integrating them into other components. So now we're looking at work with integrating with commercial bank money, like it works today in the financial system, or how we integrate with securities, how it works with generally government bonds, because you have to buy something. A bank has to buy something with it. So the last question is, what does this mean for you in this room? Well, there's several things that this means. One, for central banks, it means more stability, right? A better financial system that's more stable. For banks and payment service providers, some of you may operate in that space here, this means more access to liquidity, less risk, better services that you can provide to your clients. And for end users, faster, cheaper, better services. Like Fed moved from horse and carriage to Fed now, it's about faster, cheaper services. I'm happy to take questions, but I'm gonna take the first question that I assume will be asked anyway. Can you guys do this on public blockchain? And, well, my opinion is yes, you could. And the central banks should probably put central bank digital currency on public blockchains. But here's the problem, and the BIS will say, no, we can't. So there's two sides of a coin. Now, one side says, well, if you can't do it, why? And it's basically regulation and compliance. Central banks can't do it because of regulation and compliance. And so one side says, well, let's just change the regulation and compliance to make it work. But you have to keep in mind, there's 190 plus countries in the world, several central banks trying to get the legal regulatory framework changed in all jurisdictions. Probably will take 20 to 30 years. Look how long it took MiCA to get done. The other side of the coin says, well, we have a financial system that works with the current regulations. Why can't we just adopt the technology to that? That'll take probably 5 years. So if anyone can make that decision, 20 years or 5 years, they'll probably take the 5 years to get better access to services and systems now versus trying to change the entire regulatory scheme across all countries around the world to make it work. So I'm happy to take questions, and I don't know if there's a thing for questions here or not.
Thank you, Mike. I'm the thing for questions.
Fantastic.
So we have one question from the audience. What's the worst thing that can happen with CBDC rollout?
It takes too long. So I want to be clear on the CBDC rollout for commercial banks, right? For the retail, it's more political, and I think I don't know if the question is trying to go towards the retail or the wholesale, but for wholesale, it just takes too long, and maybe the commercial banks do their own private sector thing to kind of make this work. For the retail side, it doesn't get adopted. And the retail side, it's a few things. So depending on the country, they probably want retail CBDC, or they may not. And a good example is the Eastern Caribbean Central Bank. Who has heard of them? Exactly. It's a group of islands in the Caribbean. It's 7 countries, and they have like a trade union of using a single currency. Now, the problem that they have is that payments are expensive. So if you use a credit card in any of these Caribbean countries, do you know how much it is? It's 20%. 20% is a lot. And the credit card companies have a monopoly on that price because people will pay it. So people in the countries use actually cash. Now, what's the problem with cash? It's expensive and difficult to transport between countries. And so their need is it's actually more just, it's cheaper and better. And so the rollout for retail CBDC there is actually more for controlling cost and making it cheaper for the central bank, but also for consumers. So.
Thank you. We have one more question. What is the level of privacy that you would encourage?
Good question. So on the wholesale central bank side, commercial bank-to-bank payments, there's already privacy. They're run by the central banks. On the retail side, we've done experiments on making it anonymous while still compliant. And so, here's a good way to think about it. If central banks were to introduce cash today, they couldn't because of all the regulations and compliance about know your customer, AML, etc. So you could not introduce cash today. But for CBDC, this is going to be the political point, is where do you do privacy and also maintain a level of compliance that's fit for the regulation jurisdiction. So we've tested an anonymous CBDC that's also regulatory compliant using blind signatures from David Chauman. That was a really fun experiment. So.
Thank you. One more question just showed up. Are those solutions open source?
So a lot of them are open source for the central banking community. What we're trying to do now in our program is to actually make it open source for everyone. But as you can imagine, getting several central banks to agree on what to open source is actually very, very difficult to do. A lot of talking, a lot of discussions. It's not just one person that makes the decision, it's actually a group of central banks. But that's the goal.
Thank you so much, Mike. Thank you for your time and for explaining everything to us. Thank you.